Good evening, everyone. For those who don't know me, my name is James O'Neill and I am the country head of FairMarkets Trading, a ASIC regulated broker. Tonight, we are very excited to have Opus Trading Group's very own Philip Salam, who will be doing a course on the introduction to trading. Philip, take it away.
Beautiful. How are you guys? Welcome back. For those of you who don't know me, I'm Philip. I have been trading for around 5 to 6 years now. And doing these intro to FX trading are always exciting for me because it really does take me back to my journey where I first began. And I remember I started, prior to actually starting trading, I was working in the medical field, and I was actually working in medical radiation in a hospital. And I remember I came across trading through cryptocurrency, and I was there. I used to work overnight shifts, and I used to be reading and studying and looking up videos about FX trading all night through my shifts. And this really does take me back there. So it's always exciting to actually be teaching this to people who are interested or wanting to get into trading. Now, before I get started, I just have to display firstly a disclaimer from FairMarkets, and I'll have to display my own disclaimer as well. So everything in here today is purely for educational purposes, just so all you guys know. Okay, so first things first, a lot of you may be wondering and are in here because you're interested in Forex and what it is. And some of you might not even know what Forex actually is. So the word Forex stands for foreign exchange. That's where the F-O-R-E-X comes from. So Forex is actually it's a global currency market, and it's the simultaneous exchange of one currency for another. So a lot of you guys would have traveled overseas. When you go to exchange money before traveling to another country, that is a form of a Forex transaction when you're exchanging one currency for another. So the foreign exchange market is also the most liquid in the world, meaning there's over $5 trillion that are changing hands every single day. And I'll explain where that comes from as we go through this presentation. So there's always a transaction that's happening between two currencies. So you're having one currency being bought and another being sold at the same time. The market, which is open 5 days of the week, 24 hours of those days, it's open from 5 p.m. Sunday to 4 p.m. Friday Eastern Standard Time. Now, if you do live in Australia and you are from Sydney, that at the moment, I believe, is from 9 a.m. Monday up until 9 a.m. Saturday. And it's Saturday because you got to think the American session is pretty much ending the Forex market for that week. Now, there's a lot of people involved in Forex trading, and these can include investors, retail traders, which is you and me pretty much, banks, and many other people. So before I keep going ahead, there's also a big misconception in FX, and there's a lot of people that think that stocks and Forex are the same thing. And when you tell someone that you trade Forex, they seem to think that you are trading stocks. However, traditional stock investing is very different from Forex, and I'll explain to you guys how. When you're involved in traditional stock investing, you are buying a share of a company. So you're buying a part of a company as you believe that the shares are going to be worth more than you purchased them for at a future date. However, in the Forex market, currency pairs are quoted by the major banks. There's a middleman known as the broker, which is in this case FairMarkets, let's say, and they'll deliver the price at an average price. And therefore, the retail traders, which is you and me, are then able to buy or sell the currencies, which is done between us and a broker, not between us and any other person. So pretty much all our transactions are done between us and the broker, and we're not directly being involved with other people where we're buying and selling from them. And there's also a thing, so with stocks, when you're traditionally investing in stocks, you are purchasing a stock, you're waiting for it to go up, and that is technically how you can make a profit from investing in a stock. However, in Forex, and I'm going to explain it in a second, you can actually make money from a currency going down in value also. Now, who is involved in Forex? And that's a very, very important point, because we need to understand who we're coming up against in order to understand how the FX market works and how we can actually perform our best in the market. So as the retail trader, it's important to understand that we have governments, banks, commercial companies, hedge funds that we are going up against in a way, and they are involved in the Forex market. So if we look at this table, for example, we have the governments and central banks. So what is their involvement in the FX market? So they aid pretty much with the financial imbalances. They make decisions around a country's inflation, money supply, and interest rates. Then you've got commercial companies. Commercial companies, they take part in the Forex market for the purpose of doing business. What does that mean? If you take a company, for example, such as, let's say, Apple, Samsung, any of those big commercial companies, when they are doing business offshore from their home country, they are pretty much dealing in transactions in that foreign currency. Let's say Apple is selling their phones, laptops, and electronics in Australia. They are making Australian dollars in AUD. At some point, that money needs to go back to the US to be converted, and it has to be converted back into US dollars. Now, that in itself is a form of a foreign exchange, of a Forex transaction. And that is why it is the most liquid market. And that is why I said prior that there is over $5 trillion a day getting exchanged. Then we have the big banks. So the big banks are the ones that determine the exchange rates. So for example, the Australian Reserve Bank of Australia, the RBA, then you have the US, the European Central Bank. They are all responsible for determining the exchange rates. They base that on the supply and demand of those currencies. So the more demand there is for a currency, that is how they set those prices and the bid, the ask, and the spread. Also, the banks themselves take immense amounts of transactions every single day, both for themselves and for their customers. Next up, we have the hedge funds. So hedge funds are pretty much large speculators with big pockets. As many of you might have heard, you can actually go invest in hedge funds. You can give hedge funds X amount of dollars. In exchange, they'll pool it into one big fund and trade it for you, giving you a percentage of a return on their profits. So they are also involved in Forex. Now, what you can see is this is the 90% up here. And the retail trader, which is you and me, we are the 10%. And why am I showing you this? And why am I telling you that we are only the 10%? Because it's good to keep in mind that no matter how big of a trader or how much trades we take on the market, we are very, very minuscule, and we are not going to pretty much have any effect on the direction of the market whatsoever. A lot of FX is very mental. It's a lot of psychology, and understanding who you're coming up against, understanding who your competitors are and who's involved is extremely important. Now, I was also talking, we get to what is a CFD. So CFD is a contract for difference. That's what it stands for. And previously I was telling you, in comparison to traditional stock investing, in Forex, you can actually profit from a currency going down in value. And that is for the simple fact that you can actually short or long. So the meaning of long is when you can actually anticipating for a price to move upwards, and that is how you will make your profit. If you short a particular currency, it means you are anticipating for that currency to go down in value. And if it does, that is when you will also make your profit. And the reason for that is because we are trading CFDs. So CFDs, being a contract for difference, it's a type of financial instrument that allows us to benefit from the price fluctuations going up and down without actually owning the underlying asset. So it's very important to understand that when we are trading a CFD, when we are trading currencies, we don't actually own the currency. We don't own that underlying asset. Instead, we own a CFD, which is the contract, and that's what allows us to take those longs and those shorts also. So what's the key points of a CFD is that it's an agreement between an investor and a CFD broker to exchange the difference in the value of a financial product between the time we open the contract and the time we close it. So pretty much from when you open a trade up until you close it. A CFD investor doesn't own the underlying asset, but instead we receive the revenue based on the price change of that asset. And the advantages are that we can actually get into the position pretty much. It's easy to execute. We are able to go long, we are able to go short, and it's a very simple process that has been made. Now, what is the advantages of Forex trading as a whole? There's a few points here as what the advantages are. So firstly, we can say it's rewarding. Because it's the most liquid market, it is also the most rewarding to trade. However, there's one thing I want you guys to keep in mind is just because it's the most rewarding, we also have to keep in mind that it can also carry a lot of risk. So it's important that yes, we do have, it's kind of like the pendulum, we swing one way with a lot of reward, but we have to understand that there's also a lot of risk. And that is why it is very important to go into FX trading with the correct education in order to actually understand all these things and come out on top. The second point is flexibility. So the Forex market is open 5 days of the week, meaning the weekends are for relaxation. Control. Just because the market's open 5 days of the week, it doesn't mean that we actually need to trade all those 5 days. There's actually absolutely no need to. You are completely in control and you have the freedom to trade when you like, and you have the freedom to not trade when you like. And the last point is freedom. So due to the advancements in technology, if you pretty much have an internet connection, electronic device such as a phone, a laptop, or a tablet, you can pretty much trade from almost anywhere in the world. So these are the great advantages of FX trading. Now we have two types of traders and their analysis. So an analysis is how we actually try and determine to predict the price movement that's going to occur in the markets. And there's two types of traders, and that there's two ways of analyzing the market. So the first way is what we know as technical analysis. Technical analysis is where we rely on charts and the study of historical price movements in order to try and visualize and identify those patterns and signals to predict where the price is going to go in the future. So a lot of you might have seen charts with the little candlesticks. These are the charts that we are trying to actually study in their historical price movements. So all the charts they're a representation of the price of the economy and the fundamentals of that economy. So what are the fundamentals? And that brings the second type of analysis of a trader, and it's called fundamental analysis. So fundamental analysis purely means that we are analyzing news and using that news to try and determine what's going to happen to the currency of that country and economy. So that's a form of analysis where we're mainly relying on the economic news and the data that is being released in order to predict the price movement of that currency. So they rely on the belief that the fundamentals are the key drivers of a currency, and regardless of the short-term movements, these fundamentals are going to determine the overall direction. Now, just because you can analyze one of the two ways doesn't mean you have to be one of the two. You can actually combine the two in order to put them to your advantage on the charts. What are the styles of trading? So just like in sports, there's different styles of performing a sport. There's also different styles of trading, and they can be pretty much broken down into, I would say, the three main categories, which are known as swing trading, day trading, and scalping. So what is swing trading? Swing trading is pretty much the medium to a long-term type of trading where trades are actually being held from days, weeks, months. they're generally longer term type of trades. You need to pretty much place large stop losses and take profits. That's where you're pretty much aiming to take profit at. It is, I would say, it's for a bit more experienced traders, as the position might take some time to actually occur. Meaning, if you're just a beginner and you're going to wait 3 weeks and then your trade doesn't work out, you then have just used 3 weeks where you didn't quite understand the charts, you didn't learn much from the charts. That's why I would say day trading and scalping are what every beginner, and that's how I started, usually tend to go towards. So day trading is, as the name says, it is a style of trading where trades are typically held and closed within day or days. And that's a good form of trading for beginners. Why? Because they're able to actually make more mistakes, because by making a mistake, they can then learn from that mistake and then try and apply it onto the next trade. They are generally more involved in the markets. They can try and learn more and educate themselves more through trading. And the last we have is scalping. So scalping is a style of trading that actually involves traders looking at low time frames. It's entering and exiting trades in a very short amount of time. It's fast paced. Some beginners tend to go towards it because they enjoy, just the very quick movements of the trade. They like being in and out of a trade fairly quickly. However, I would also like to point out that just because you're in and out of a trade quick, that can also mean that you can lose a trade very quickly. So it's very important to, once again, educate yourself on the style of trading, depending on yourself and you as an individual, on your lifestyle, on your life as a whole. Every style will actually might fit or suit you more. So it's very important to actually take these things into consideration. So now we come up to Forex terminology. So Forex terminology pretty much means that Forex is a language of its own. It has a language of its own, and it's very, very important to actually understand that language before you get started in FX. So what we have first is currency pair quotes and their exchange rates. As I said, firstly, currencies are traded in pairs. So you always have one thing against another, a base currency against a quote currency, what we call them. So they're quoted in pairs. And as you can see here, we have Euro/USD. We have the base currency against the quote currency. When you have Euro/USD and then you are looking at a chart, what that pretty much means is if the chart is going in an uptrend, moving to the upside, it means the Euro is gaining strength over the USD. If the chart is moving to the downside, it means the USD is gaining strength over the Euro. So the currency at the front, the base currency, is pretty much determined being strong, or it's actually gaining strength by the chart moving up to the upside. And if the chart's moving to the downside, that's determining that the quote currency is actually gaining strength. Now, next thing many of you might have heard of, and if you haven't, is known as a pip, or a percentage in points. Now, what is a pip? A pip is pretty much the smallest increment of a price movement that a currency can make. Now, currencies move in very, very small increments, and there's a lot of profit that's made in those small points that are moved. So if I go to the next page, this is what we can see. So these are how currencies are quoted. So let's say we have the Euro/USD, we have 1.15759. There is a total of 6 digits over here. Now the pip is the 4th digit after the decimal point in any quoted pair. So you can see here, that's the number 5. And if we go up to 1.15769, that is a movement of 1 pip. The last digit is what's known as a pipette, and it is pretty much a 1/10 of a pip. It is too small for us to even recognize. That's why the pip is what we actually look at and care about. Now, there is only one exception where the pip is not the 4th digit, it's the 2nd, and that's with anything that is being quoted against the Japanese yen. So whenever you see any currency that's quoted with the JPY or the Japanese yen, the pip is the second digit. And the reason for that is because we actually have 3 digits before the decimal point, and we have the 1, 2, and the pipette, which is the third one after. So that makes the 8 here the pip. And if we go to 114.09, that is a movement of 1 pip. So just to sum that up, any currencies that are quoted together that don't have the JPY, the pip is the 4th digit. If it has the JPY, it's the 2nd digit. And then we have what's known as the spread. So the spread is the difference between the bid and the ask. So what is the bid and the ask? Pretty much when you want to sell or buy a currency, you're going to see a bid and an ask, as you can see in this table over here. Now, the difference between these two values are what's known as the spread. This spread is pretty much the bid is the price a trader is going to pay to sell a currency. So if you want to enter a sell or you want to short any of these currencies, you're going to get it at the bid price. If you want to buy any of these currencies, you're going to get it at the ask price. And that difference in between, that's known as the spread. And that's pretty much a small way that a broker can earn money on that trade. So the broker is actually offering us up the capability to be able to trade. And that is the way that they can actually profit from a trade also. Now, the most liquid and popular pairs in the world, and I'll get to them in the next slide, they usually have the lowest spreads. So if you look here, Euro USD, which is the most popular pair in the world to trade, it's almost got a 0 pip spread, which it does. If you look at it, it's only a 1 pipette spread. Where if you start looking at things such as, let's say, the pound against the yen, if we look here, we have a 1 pip spread. So the difference between the 5 and the 6 over here. Now, what are the major currency pairs of the world? We have these 7 over here. So they are what make up the major currency pairs of the world. So we have the euro against the US dollar, US JPY, USD British pound, so the Great British Pound, USD CHF, which is the Swiss franc, AUD, which is the Aussie USD, USD Canadian, and New Zealand USD. So these 7 currency pairs make up the majors of the world. So these 7 actually represent 80% of all Forex transactions done worldwide on a daily basis. Now you might have noticed these are known as the commodity currency pairs. Now, what does that mean in comparison to these? They are all the majors. However, these are known as the commodity-based currency pairs. Well, that's because the Aussie, the CAD, and the New Zealand are what's known as commodity-based currencies, meaning their countries and their economies rely on commodities in order to make sales, and their economy is based around the commodities. So if you look at the Aussie, we've actually got a lot of coal, iron ore, gold mining. The CAD is actually, I think, the 2nd biggest oil refiner in the world. And the New Zealand has a lot of milk, wool, meat, and gold. So all these commodities are actually what the economy thrives on. And that's why they're known as the commodity-based currency pairs. Next up, we have the contract sizes. So all Forex transactions on the market are done in what's known a lot size or a contract size. So a contract size is known as a standard lot. So that word right there, lot, stands for 1 contract size. So 1 contract size in the FX market means it's 100,000 units of the base currency. So if you have a USD based account, when you take 1 lot on the market, it generally means as if you're taking $100,000 worth of a position on the market. Now, every pip movement in the market on 1 lot is equivalent to $10 USD in your account. So let's say you take a buy position with one lot on a USD based account, every time the market moves 1 pip, you are profiting $10 USD. If it moves against you, you are going into negative $10 USD. 0.1 is a tenth, so it's 10,000 units. 0.01 is 1,000 units. Now, why that's important is because when you're going to start trading, you're going to put money into an account. And the next point I'm going to get to is a lot of people think that you actually need a lot of money in order to trade. However, there's what's known as leverage and margin that allows you to actually have little amounts of money that can be pretty much magnified in order so you can trade these smaller accounts. So leverage pretty much is the way that you are able to trade those larger amounts. So what happens is the broker will offer different levels of leverage. So depending on yourself and you as an individual and your situation, how long you've been trading for, you'll be offered different amounts of leverage. So the amount of leverage is pretty much the buying power or the borrowed fund capability that will allow you to buy or sell. So for example, if you have $1,000 account and you take $100,000 position, it means you took one lot on the market, because one contract size from the previous slide is $100,000. Now that means that you have actually been leveraged 100 times. So on your $1,000 account, you were able to open a contract size equivalent to 100 times your account size. If you take a $300,000 position, which is equivalent to 3 lots, that's a 300 to 1 leverage. So you can trade the Forex market with less money than you actually think you need. You don't need $100,000 in order to trade the one lot. All you need is the leverage that's offered to you by the broker. Now, all these things might sound confusing. They might sound complicated. However, there are, for example, calculators. If you don't know what amount of lot size you need to take, there are calculators where you input how much money you have in an account, how much you want to risk out of it, you input what pair you're trading, and it will automatically tell you, based on your risk tolerance, how many lots you should be taking. So you don't need to actually physically calculate the lot size you need to take. Next up, we have what's known as the Forex sessions. So the Forex markets are generally separated into 3 peak activity sessions. Just because the market is open 24 hours of the day, it doesn't mean that the market conditions are actually good and ideal to be trading at all those times. So the market's divided into 3 peak sessions, which are known as the Asian session, with Tokyo being the main, the European session with London being the main of that session, and the North American session with the New York being the main of that session. Now, these times are in GMT over here. However, you can find also many different websites where they can automatically convert them to your time zone in order for you to understand what session you are trading within. So if you look at this chart over here, there's one thing I'd like to point you guys to, and there's these overlaps in the sessions over here. Now, these peak sessions, you have to understand, if you're trading something like the New Zealand dollar against the Japanese yen, the session that will be active in would be in the Asian session. And why that is because you got to look at as when are all the fundamentals, data releases, and information on those currency pairs coming out. It's going to be coming out during the day of those countries that those currencies belong to. So if we're looking at the New Zealand and the Japanese yen, that's all going to be coming out during the Asian session, meaning the New Zealand and the Japanese yen are most likely going to be traded and ideally traded at in that Asian session. Not always, but I'm just saying ideally. The European session, if we're looking at the pound, the euro, the Swiss franc, that is the session where their banks are open, the country that these currencies belong to are open, and that's where they're going to be peak trading at. Same with the North American session with the US dollar. So in other words, it's very important to understand these openings. So the opening times of these sessions play key roles in trading. I go into this deeper, of course, in my course, where I'll explain how these openings of these sessions, the exact times that I kind of look at, because I understand after looking at the markets day in, day out, the effects that these times have on the markets. Now, there's different ways of also executing orders. So that's another terminology in FX. So as you can see here, when you're executing an order, it's going to ask you the volume being, this is the lot size. This is your stop loss take profit, which I'm going to get to in a second. And this is what's known as a market execution. Market execution simply means if you hit sell or buy, you're going to execute there and then live in the market. We have what's known as a limit order. A limit order is where you pretty much are putting a trade or an order at a future time, future place, where if the market moves up or down towards that order, it will automatically activate it and go on from there. So what's a stop loss and a take profit that you've probably heard me say a few times up until now? So a stop loss in FX is pretty much designed to limit your losses from a trade. So you got to look at your stop loss, or also known as stop order, stop market order. It's pretty much like a safety net. That's how you have to look at it. Where if a trade moves against you by a certain amount, you can say, I only want to risk 1% of my account on this trade. You place your stop loss at that 1% mark. That way, if the trade does not go your way, the market will automatically, or the broker will automatically close your trade at that level. And that's sort of your safety net. However, it's very important to understand that stop losses don't necessarily always have to be fulfilled at that exact level. So it's also very important to have your risk management in place behind those stop orders also. The take profit is pretty much the opposite of a stop loss. So it's where you want the market to close you in profit. So let's say you take a trade, you're not looking at the chart, or you fell asleep. You don't want to leave your account exposed. So you put your stop loss, you put your take profit. If the trade does go up to your take profit, automatically it will close you in profit. Another thing to remember is very important as well, is even after you take the trade, you can move those stop losses and take profits at any time. You're not locked in once you place them. You can actually open your take profit. You can move your stop loss to what's known as break even, meaning even if the market was to turn around, you're pretty much leaving your trade safely. Even if the market turns around, it's going to knock you out at break even, meaning you're not going to lose anything out of your account. So here we have the Japanese candlesticks. So they are what you pretty much see on a chart. Now I've put them in black and white because colors can be set and determined by you. You don't necessarily, there is no set color for the buy candle. There's no set color for a sell candle. So you can pretty much determine these colors yourself. That's why I've put them in black and white. And just a little background, the Japanese candlesticks were actually invented in Japan, and they were invented because they were trying to illustrate the price of the rice back then. And they actually started the Japanese candlestick in order to be able to visually represent the price of rice. So that's where they come from. And now if we look at this candle, this is what's known as the body of the candle over here. This is the open. So this is where the candle opened. This is where the candle closed. And these are what's known as the wicks, shadows. That's pretty much where the market moved down and moved up. So the lowest point, the highest point, and then where it opened and where it closed. So if it closes higher than where it opened, it's known as a bullish candle. If the market opens and then closes below where it opened, it's known as a bearish candle. So this is the complete opposite of this candle. It's where it opened at the top, closed at the bottom, and this is the high and low of that candle. Now, visual representation as well as to where the terms bullish and bearish come from that you might have also heard. So the term bullish comes from the way a bull attacks is actually from the bottom upwards. So a bullish market is known as an uptrend, a bullish trend, pretty much the price on the chart is moving to the upside. So that's where the term bullish comes from. And bearish is because a bear attacks from the top down. And that's what's known as a bearish trend, where you would say that the market is moving to the downside. Now, what's market structure? So pretty much the only three ways a market can move and the price can move on a chart is in three ways. It can move horizontally, upwards, or down. There is no other ways that the market can pretty much move. So a ranging market, which is known as a horizontal market, is where the market is pretty much bouncing between a support and a resistance level. So that's what we can see over here. So this is a ranging or horizontal market where these are the candles. So as you can see, these white candles are the bullish candles. So it opened here and closed here. Then the market opened here, closed here. And that's what makes it a bullish candle. And this is a bearish candle. And these are all these black candles are bearish candles where they opened and then closed below where they opened. And the market structure of this market is a ranging market where we can see we've got a support level where the market, support and resistance, all you have to remember is the floor and the ceiling in a room. The support is like the floor where you can't go through it up until it's broken. And the resistance is like the ceiling where you can't go through it unless it's also broken. The next market structure is what's known as an uptrend. So it's where the market is creating these sets of higher highs and higher lows. So if you have a low, you have a high, you have a higher high, higher low, higher high, higher low from the previous. So you can see all these lows are getting higher, the highs are getting higher, and that in itself is what creates this uptrend market structure. And in the opposite direction, we have the downtrend, where instead of forming higher highs and higher lows, we are now forming lower highs and lower lows. And as you can see, that's what creates a downtrend, a bearish trend, all these terms that we can call a downwards trend. So these are the three that we've explained over here. So you have the horizontal, upward, downward, ranging, uptrending, downtrending. And they can be visually represented on a chart with this, this, and this. And that pretty much wraps it up for today. This is the intro to FX. So I hope that by what you heard today, you were actually able to gain a great understanding on what the Forex market is, how it operates, how it works, what it's all about. These are pretty much all the little intro to FX key terms that you guys need to understand before you actually start searching or doing anything further. All these things are what make up the beginners or the intro into FX trading and into the FX world. I really do hope that today was really educational for you guys, especially the guys that have never heard of FX before. And I would really like that you guys open up the chat at the moment. Please feel free to ask me any questions before I head off, because I really want to answer any questions that you guys have. So instead of just raising your hand to talk, if you can just please open the chat and just type your question in there. And I want you guys to please also give me some feedback. Let me know if there's anything you did not understand. I'm more than happy to go through it again.
I believe Louis has a question.
Yeah, Louis, can you please just open up the chat and type it in? Louis, if you use your Zoom, you should be able to see a little a little section on the Zoom, there should be an area called More, and you can actually open a chat box in there.
So I've allowed Louis to ask a question.
Can you hear me? Can you hear me?
Yeah, I can hear you.
You say the commodity pairs like AUD, CAD, and NZD, like they depend on commodities, right? Like oil, something like that. So if there is like a news like regarding oil, something like that, like will those pair be affected?
Definitely. So if we look at the beginning of COVID in 2020, oil, there was a time where if you recall on the charts, oil went down to zero.
Zero and nothing, yeah.
Correct. And if you look at the Canadian actually got very negatively affected because the oil was getting affected. So if you look at a chart like USD CAD, the USD CAD was moving in an extremely bullish momentum, meaning US was gaining a lot of strength over the CAD. And if you look at a lot of the charts against the CAD, they were all gaining strength around that period over the CAD because of oil directly.
Oh, I see. So even if like there's no news like on USD, like if CAD is like doing bad, the USD graph will go up?
Correct, because it's not necessarily only the USD that has to be gaining strength over the CAD. If the CAD is weakening itself, then that will cause the USD to gain strength automatically against it.
Oh, I got it. Yeah.
Does that make sense?
Yeah. Oh, yeah, it's clear. Thank you so much.
No problem.
Does anyone else have any questions? I know that Philip's a wealth of knowledge when it comes to FX, and we're extremely privileged to have him in this webinar for us.
Thanks for that, James. And I would also like to add on, guys, that I'm extremely grateful that I'm here with FairMarkets. They are my preferred broker. That's actually who I trade with and who I would recommend. So FairMarkets, they are ASIC regulated, they are in Australia, and they're the go-to.
I really appreciate that, Philip.
I can see a Q&A, however, I can't access it.
Joseph says, thank you, Philip. Very informative. Really got a lot out of this. Will this be available to download, or will it be on again in the future? Long way from med science. So I can answer that question for you, Joseph. So our webinars are recorded, and so this will be available on demand through the Fair.Markets website, as well as our YouTube channel. And we're very privileged. Next week, we've got a webinar series where we've got a special guest, Vianne, who will be discussing gold. And then Philip's back on the following Thursday for another webinar. He also has a live event coming up on the 14th of October at FairMarkets offices in One Bly. So you will all receive an invitation to that. There'll be food, there'll be coffee, and there'll be lots of information on how to get the best out of your trading from the Opus Trading Group team.
Yeah, that live event is definitely something you guys shouldn't miss, especially if you found this very educational and informational. There's obviously a massive difference between learning in person than over Zoom, and that live event is I'm going to put a lot more detail into that event than what I did today. There's going to be obviously a lot more information that I can present in those couple hours over there. So if Forex is something that you're seriously looking to pursue, I would say that you shouldn't be missing that live event.
Yeah, thanks for today's webinar. Really, like, it was good because like I've been like looking like for many like PDFs, something like that, like, and most of them they would say like Forex is a 5 trillion blah 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 liquidity market, something like that, but none of them like will explain it. You see, like deep. So like it's good. Like today, like everything is clear. Like, and I have taken notes. So thanks so much.
Beautiful. Thank you for attending.
Thank you everyone for attending on behalf of Fair Markets. We really love you taking the time out of your Thursday evening if you're Sydney based, or taking the time wherever you are in the world to hear more about financial markets. And please do, if you have the time, subscribe to our future webinar series.
Thanks a lot, guys. Thanks for attending, and thank you, James, for having me.
Always a pleasure, Philip.
All right.
Thanks, guys.
Thank you.
Have a great day. Happy trading.